Good morning. Welcome to Core Services in our Core Belief Series, Why It Matters. And today we're going to be discussing getting serial assessments right. This actually is a continuation of our post from last week where we laid out the gap requirements for the serial assessments. I'm John Coggle and I'm today's presenter. So a little bit about Core Services as we begin. We are focused on audit and review services almost exclusively towards the condominium and HOA market. We have over 40 years of combined experience working with associations, and we do offer advisory services where we'll help with board meetings, we can assist with budget preparation, and helping you determine what is the correct way to post-transaction. So this all stems from a client who had a serial assessment a few years ago, and they were told, "Oh, we can report this thing as an ongoing monthly assessment. We don't have to record the receivable." And so, obviously, as we begin to gather an understanding about this, it's important to understand what everyone is talking about when they say, "Oh, we have a serial assessment." So a serial assessment is nothing more than a special assessment. It is conducted outside the regular budgeting process. So somebody's determined a need, and we need the owners to come up with money to pay for it. So it is almost always dealing with a funding deficit. And one of the key characteristics about a serial assessment, after talking to the attorneys and trying to get their input and where they're coming from, is that they are trying to assess and levy upon the installment. So obviously one of the concerns they have is if we go out and we put a $20,000 special assessment against a unit and that person files bankruptcy, there is a good chance that with the homestead exemption, with everything else, they may be able to walk away from that full amount of that levy. And so they basically try to craft a product where, because it's levied and assessed, you are responsible for that monthly assessment amount. So that's primarily what they're really trying to get to. The other thing is when you're looking at a serial assessment, it should actually only be referencing the installment payment. So we're going to have a serial assessment which levies and assesses monthly for 395 months. You shouldn't reference anything else beyond that. Now, sometimes they try to create hybrids, which again make it a little bit even more confusing. But really the goal is, hey, we're going to treat this thing no differently than a regular assessment. And that sounds great, except GAAP has already identified this and said if it's a special assessment, you have to follow the 60525, which yes will soon be superseded, but we won't worry about that today. And so what that says is it recognizes revenue and a receivable when you identify the funding deficit. So if you are dealing with a funding deficit, economically speaking, the association has a claim for that amount of money from the current ownership that is voting for the serial assessment. Now, obviously, it gets a little bit more challenging if you are making a special assessment, and let's say you have a project coming up in 2 years, and you're saying we are doing this serial assessment to address that particular project. The revenue then follows 972-430, which is you have to defer that until you do that special assessment project. So remember, what it is it's dealing with the funding deficit. And so the moment you say we're short money, you are making a claim, an economic claim to those owners. You are saying, hey, look, you need to chip in more. You can't just defer, push that into the future and say somebody in the future is going to be responsible. You are saying it's a problem now. Current owners are responsible for it on an economic basis. And so what you have to do is when you do those serial assessments like that, even if you did it totally correctly, you would look at the amount of money that's being collected above your current operations and bring that amount on a discounted cash flow basis to record the receivable. And as payments come in, you debit the receivable or credit the receivable, debit the cash, and then obviously credit the interest component for that series of payments. And obviously, if the more it's written like it is a assessment today for the full amount, And if it says interest and it says it's going to run for 120 months, and oh, by the way, owners have the right to pay it off annually or at any point in time by making a phone call, management probably needs to keep an amortization schedule going, which also then allows for the opportunity for people to know exactly where they stand. But if you're not careful, it also potentially leads to the risk where your assessment amount, it deviates from the amount that's allowed for the declaration. So you have to remember that if it's $1 million assessment and your owners own between 0.5 and 1.5% of the property, you have to make sure that when they're done with their assessment that they've paid that amount based upon the amount they were responsible for in the declaration. So what are some of the non-GAAP treatments you'll find? Well, we've been seeing some interesting things when it comes to this. We've been hearing that there's been advice being given to management on how to handle this, which is you don't recognize the receivable. You treat it on the cash basis. When the payments come in, it's due, and that's when the revenue is. And if somebody prepays, it's all revenue. No, GAAP says that's not appropriate. And so sometimes there might be an election inside the form that says, hey, you can elect to be responsible for the full assessment now or responsible for the full assessment as it comes due each month. Doesn't matter. GAAP says receivable, because you've actually made it worse there when you've given people the option to pay $10,000 up front or $100 a month for the next 120 months. You've told me what the present value is. I can back into the interest based upon that differential between the $10,000 present value and the present value of $100 a month over 120 months. And then the other thing you're might be told is, oh, well, because the payments are coming in and it's all an assessment, it is all revenue, and that would be incorrect. Because if that special assessment goes over 12 months, ASC 835 would kick in, which is the imputed interest rules, which says you must recognize interest on those because you've allowed that to be a receivable over for a period extending beyond 12 months. So why does it matter? Well, because at the end of the day, you as a board are responsible for establishing policies, and that includes the accounting policy. So if you say we are going to follow generally accepted accounting principles, you need to make sure that the advice you are being given by your managers and ultimately their accountants fits GAAP. And so when they come to you and say, oh no, you can do this on a monthly basis and just record the receivable on somebody who hasn't made their payment, please understand that may not be correct. You need to look a little bit deeper. If your managers are sitting there going, well, we were told by our CPA this is the way to do this, understand that you may need to look deeper. You have a fiduciary responsibility to make sure your financial statements are prepared accurately and consistent with generally accepted, assuming that's your accounting policies. If you, on the other hand, want to make up your own accounting policies, by all means, you have to disclose that. Your CPA may not be able to sign off, that is, your financial statements are prepared in accordance with GAAP, but you can establish non-GAAP treatments. But the end game, really, if you're going to loan money to your owners because you don't want them to have to go through and pay a lump sum up front or go borrow money from the bank on their own terms, you're acting like a bank. You need to address the accounting issues behind becoming a bank. Our advice is obviously the less you act like a bank, the happier you're going to be. So if you need to do a special assessment, assess, let the owners pay the lump sum, or figure out a way to borrow the money from other parties other than their association. It's too complicated and you don't want to be here. So anyway, we hope you found this little series informative. If at any point in time you have questions, feel free to contact either Doug or me on LinkedIn. You can find us on www.core-acct.com. We have a contact sheet there. You're more than welcome to send us any questions. And obviously you can contact me on Twitter at John Coggle. So hope you have a great day. We look forward to talking to you again soon.